Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Foresight stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Foresight designs and develops sensor systems for all vehicles, but its main focus is on driverless cars. The company's technology scans the road to mitigate possible collisions with vehicles, people, animals, or any obstacle. The company received 10 patents, and it owns 100% of iNet Mobile and 19% of Rail Vision. We'll talk a little more about these companies later. Foresight develops both in line of sight vision systems and beyond line of sight cellular-based applications. Its systems are designed to improve driver safety. It believes its advanced systems will revolutionize automotive safety. The company is headquartered in Israel and was founded in 2015. The ticker trades on the Tel Aviv Stock Exchange, NASDAQ, and Deutsche Börse. Let's get started with the model. This is a microcap company, 60 million market cap. They're trading at 94 cents a share, and they have 65 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. And their free cash flow is negative every year since they're pretty much pre-revenue. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's also negative each year. Revenue is the sales for the company, and that's zero in 2018, 19, and 20. A little over 100,000 in 2021. This is the company's income statement. The top line is the revenue of the sales. That was 120,000 in 2021. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that's 53,000 in 2021. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. Their big operating expenses, R&D, research and development. Then you have your operating income, which of course is negative every year. They receive $887,000 of interest on their investments. They don't pay any interest on their debt. They did pay $18,000 on financing costs. Other income and expenses are the gains or losses not part of the company's core operations. If it's a big negative, it's likely an asset impairment. And the bottom line of the income statement is their net income, which is negative $15 million every year. This is the company's income statement from their annual report. This gives us a little more info than Yahoo Finance. They had their first revenue in 2021, $120,000. In May of last year, they entered into a joint POC project, proof of concept. That was with a leading European car manufacturer. This project is to test the company's stereoscopic technology. That's where the $120,000 came from. They spent $10 million in R&D, $1.8 million in marketing, and $4 million in G&A. G&A is mostly payroll. So of course they had an operating loss. Their loss per share went from 10 cents to 7 cents to 5 cents. And you can see their shares outstanding increase every year, 149 million, 220 million, 321 million. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. They lost 12 million in 2021. They spent 235,000 in CapEx. Operating cash flow minus CapEx gives you your free cash flow. And they're running their business on capital stock. They issued 11.2 million of stock in 2018, 6.5 million, 45 million, and 14 million. Every time a company issues common stock, it increases the shares outstanding and makes your shares less valuable. This is the statement of cash flows from their annual report. In their investing section, they invested 12 million in short-term investments, and they bought 235,000 of fixed assets. This is probably machinery or equipment to research their products. They raised 14 million of common stock, 600,000 of warrants, and 57,000 of options. So they had a cash inflow of 14 million in their financing section. This is the equity section on their 12/31 balance sheet. They have 48 million of equity. They raised 128 million from selling stock, and they lost 80 million from running their business. Accumulated deficit is the sum of all the company's prior net incomes. Let's look at the capital structure. They have 48 million of equity, 3 million of debt. They're 95% equity, 5% debt. and they could pay off all the debt with the cash on their balance sheet and have $43 million of cash left over. This blue line is their equity balance since 2016. The orange line is their cash balance. You can see their cash goes up similar to their equity. So it appears they're not spending much cash. They may be saving it for an acquisition target or a big project. I gave them the highest whack on Finbox, 10.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $124 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $75 million. We divide that by 65 million shares. And we get a calculated stock price of $117. They're trading at 94 cents, so they're trading at a 20% discount. It's a buy according to the model. Their revenue forecast for 2023 is $19 million. That's how I got their revenue for 2023. And their target for 2022 is $3 million. The way I grew their revenue in 2024 and 2025, I tried to look at other companies and this company's projections, also how big the market is. It's really anyone's guess how big a company like this can get. The company may never grow and just fizzle out, or it could 10x. The only thing we can do is wait and try to get more information from the company and then build that into our model. The average company in their industry converts 6% of their revenue into free cash flow. So I multiplied their revenue in 24 and 25 by 6%. That's how I got their future free cash flows. And I assumed they would have negative in 22 and 23. This is where the stock has been trading the last 5 years. In 2017, it was over $10, and in the beginning of 2021, it was over $10. Now it's trading below $1. And the company has no revenue, so the stock price is really based off of speculation. If the company mentions a new contract with a car manufacturer, then the stock goes up a lot. And if the company doesn't mention much news for a while, then the stock goes down. So if you like this company and you like this stock, it's trading at a really low value. In the past 5 years, this stock is down 92%, while the S&P is up 81%. This is a really volatile stock. It has a beta of 3.42, so it moves about 3.5 times the market. If you like to trade options, a stock with lots of volatility can make you a lot of money. The stock is down 82% in the past 52 weeks, while the S&P is up 7%. The 52-week low is 92 cents. The high is 569. And the stock is trading well below its 50-day and 200-day moving average. 600,000 shares are traded each day on this stock. Of the 65 million shares outstanding, 58 million are on float, 14% are held by institutions, and 2.5% of the shares are shorted. This green line is the CEO's salary since 2017. And the blue line is their total compensation. Their 2021 salary is $343,000, and their total compensation is $565,000. They only have 71 employees, but their employee count has been going up a little bit over the years, so that is a good sign. If you put $10,000 into this company when they started trading, you'd be under $1,000 today. That's a 91% loss. 73% of the company is held by the general public, 20% by institutions, and 7.5% by private companies. The company is a spin-off of Magna, and they're the biggest shareholder at 7.36%. Then State Street, then Israel's largest insurance company, Mitsubishi, and Morgan Stanley. Here's the company's hierarchy. Here's Magna up here. Below the holding company is RailVision, 19%. They own 100% of Foresight and 100% of iNet Global. iNet has 17 employees, 5 patents, and that company was founded in 2018. And their technology provides real-time alerts in all weather conditions. RailVision was founded in 2016, and they have 65 employees. Foresight's focus is to make driving safer. RailVision is to make the rail industry safer. Let's look at their financial ratios. We can't look at the PE since they have negative net income. Their price to sales is through the roof because they have very little sales. They do have a good price to book because they raised a lot of cash. That's 1.2. It's stock price over book value per share. And we cannot look at their price to free cash flow since they have negative free cash flow. Let's look at their non-current assets. 2.6 million of operating leases, right of use assets. These are assets they lease from another company, so it's reported as an asset and liability on their balance sheet. They invested $4 million in other companies, and they have $500,000 of fixed assets. That $500,000 is made up of $739,000 of computers and software, $255,000 of furniture and equipment, and $392,000 of leasehold improvements, which is $1.4 million. We have to minus the depreciation of $883,000. Let's look at their non-current liabilities. The only item they have is a $2.1 million they owe on the leases for the right-of-use assets. They have a really high current ratio, 17.1. That's current assets over current liabilities. Same thing with the quick ratio, 17.1, since they have no inventory. Let's look at their current assets. $28 million of cash, $115,000 of restricted cash. Restricted cash is cash that's set aside for a specific purpose, like to buy a piece of machinery. $17.5 million of short-term investments. These are highly liquid, low-risk investments, like treasury bonds and commercial paper, $12,000 of marketable equity securities, and $660,000 of other. The $660,000 is made up of $240,000 of government grants, $284,000 of prepaid expenses. This is when a company makes an advance payment for a product or service they're going to receive in the future, and $136,000 of other receivables. This is how much money is owed to them. Let's look at their current liabilities. $250,000 of trades payable. This is how much money they owe their vendors. They owe $587,000 operating leases and $1.9 million on other. That $1.9 million is made up of $1.2 million of money they owe to their employees, $240,000 of accrued expenses. These are expenses the company has incurred but has not paid it yet, and $445,000 of other. In 2021, they had negative $12 million of free cash flow and $44 million of working capital. So it does appear they have enough money to get through 2022 without doing another capital raise. The best way to look at ratios to compare them to companies in the same industry. There are 49 companies in the same industry as Foresight, and if Foresight has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they don't have really good numbers because they're pre-revenue and they're really small. They rank 33rd in market cap at $60 million. The average is $2.8 billion. They do have a better price to book than the average because they have a lot of cash on their balance sheet, but the other ratios are a lot worse than average. So to summarize, I have them trading at a 20% discount, and this is a super risky stock. Anything under $1 billion is really risky, and this is under 100 million. But they're trading at a huge discount than what they were trading at just a year ago. They have some really cool technology, but execution is where it's at. You really need to execute and build and scale. I'm excited to see how they progress over the next few quarters. I rank their free cash flows 1 out of 10, their revenue 2 out of 10, and their ratios 1 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.